Quick question. Do you actually need a financial advisor? Here's the twist. The answer has almost nothing to do with how much money you have. It comes down to two things: how complicated your financial life actually is, and how you behave when things get scary. Get those two things right, and you'll know exactly which investor you are by the end of this video. A test that could be worth hundreds of thousands of dollars over your lifetime. Most people frame this as a simple choice: DIY or hire someone. Pick a side. That's the wrong question. Here's why. Meet Sarah. One job, one retirement account, $40,000 invested. No business, no property, nothing messy. Her financial life is simple. A basic, automated, low-cost strategy will serve her just fine. Now meet David. Higher income. But he owns a small business, a rental property, stock options, 3 different retirement accounts, a tax situation that makes his accountant sigh. David's problem was never, which fund should I buy? His problem is 5 moving parts, all tangled together, where one wrong move creates a ripple through everything else. Here's what most people miss. David isn't smarter than Sarah. Sarah isn't lazier than David. Their situations are just structurally different. That's dimension 1, complexity. And once you see it that way, DIY versus advisor starts to look like the wrong framing entirely. But complexity is only half the story. Here's the part that actually decides most people's financial fate. And it has nothing to do with spreadsheets. Your portfolio doesn't know you're afraid. The market doesn't care that you're nervous. But your finger does. And your finger has a sell button. Try this on. You've got $100,000 invested. Monday morning, you check your phone. It says $82,000, $18,000, gone, on paper, overnight. What do you actually do? Buy more. Sit still. Sell. Sit with that answer for a second, because it tells you more about whether you need help than your income ever could. This reaction has a name: loss aversion. It's one of the most repeated findings in behavioral economics. For most people, losing money hurts noticeably more than gaining the same amount feels good. That's not a character flaw. It's an ancient survival instinct running on hardware that was never designed for a stock chart. Here's where the real damage happens. Picture 2 people. Same starting money, same market, same returns technically available to both. One builds a simple plan and leaves it alone through the chaos. The other panics during a downturn, sells near the bottom, waits until it feels safe, and gets back in after most of the recovery already happened. Just 2 of those moments, repeated over 20 or 30 years, can carve out a gap of hundreds of thousands of dollars by retirement. Same market, same opportunity, wildly different outcomes. Not because one person was smarter, because one person's brain hijacked their strategy at the worst possible moment. So here's the real reason a good advisor earns their fee. It's not stock picking. Anyone can find a low-cost index fund. It's behavioral protection. A steady voice during the crash. Someone who stands between you and the one emotional decision that undoes 10 years of discipline. For the right person, that's worth more than the invoice. But let's not wave our hands at the cost. Let's look at it directly. Say you invest $500,000, averaging 8% a year. With no fees, over 30 years, that could grow past $5 million. Add a 1% annual advisory fee, and that same portfolio could land closer to $3.8 million. That's not a 1% difference. That's over $1 million. Because you're not paying 1% once. You're paying it every year on a growing balance, while that exact money stops compounding for you. That doesn't make every 1% fee a bad deal. It means the real question isn't, is this fee big or small? It's, am I getting more value than I'm giving up? For David, complicated business, multiple properties, a habit of panicking at the worst time. That fee might be the best money he spends all year. For Sarah, one job, one account, a calm temperament. That same fee is likely pure waste, and you don't have to pick an extreme. There's a middle path most people never consider. Manage your own investments day to day and simply pay a fee-only planner for an occasional check-in or a one-time plan around a big life change, a new business, an inheritance, retirement itself, expert eyes, without giving up permanent control. For a lot of people, that's actually the smartest move on the table. So let's make this concrete. Score yourself right now, honestly. Question 1. Behavior. When markets have dropped sharply in the past, what did you actually do? Stayed invested? No real stress? 0 points. Felt nervous but held on anyway? 1 point. Sold or seriously thought about it? 2 points. Question 2. Complexity. One job, one basic account. 0 points. A few accounts. Moderate complexity. 1 point. A business, property, equity comp, or a messy tax picture. 2 points. Question 3. Engagement. Do you actually manage your money consistently? You enjoy it and stay on top of it? 0 points. You handle it when you have to? 1 point. You avoid it completely? 2 points. Add it up. 0 to 2. DIY is likely more than enough. Don't overpay for something you don't need. 3 to 4. That middle path fits you best. Manage it yourself, bring in a professional for the big moments. 5 or 6. A qualified fee-only advisor could be one of the highest return decisions you'll ever make. Not because they're smarter than you, because they stand between you and your own worst instincts, right when it matters most. So don't walk away asking, should I hire an advisor? That was always the wrong question. Ask instead, how complicated is my financial life really, and can I actually stay rational when things get scary? Because the people who build lasting wealth were never the smartest people in the room. They were just the most honest with themselves about which one they actually were. Score yourself with those 3 questions and drop your number in the comments. I'm curious how many of you land in DIY territory, and how many of you just realized you've been avoiding help you actually need.